This is episode 209 of Zen and the Art of Real Estate Investing with my guest, Jeremy LeMere. Jeremy is the co-principal at Navigator Wealth Management, where they direct and offer investment opportunities. And these are client direct fund investments to specific deals. Jeremy started in single family flips, got into apartment investing, and since 2018, he's been passively investing in out-of-state assets, doing some hard money loans, syndicating in a variety of areas as a means to diversify his own investments. Jeremy, welcome to the show.
Thanks for having me, Jonathan. I'm glad to be here.
Yeah, I've been really interested. I'm doing my back research, and you've really stayed fully diversified since you got into real estate. Tell me how important that is to your overall investment plan.
I think it's really important because it gives me the opportunity to stay in real estate on a broad spectrum,
Yeah,
but yet be able to move asset classes when the cap rates kind of adjust in one, but not another. There's some arbitrage that happens in that space. And while playing in the backyard, it still offers us the opportunity to maximize our return on the investment.
yeah, I completely agree. I mean, I grew up in investing and I've always been kind of diversified. I also like other things like stocks, but real estate's so cool to me because there's so many asset classes and just geographically you can be diversified, right? Is that part of
Yep.
your strategy and just making it very wide? And also it keeps you from getting bored, right?
Yes, it does. There's differences, there's nuances between commercial, self-storage, the multifamily space. And frankly, I've pretty much exclusively exited now my single family and duplex properties, but that's a different clientele in itself, depending on what price point you purchase your assets at. So yeah, it's been a great opportunity to really learn and get a feel for all those different elements and sort out what might be the best time to get in and out and what clientele you really want to work with on a day-to-day basis.
Yeah, that's really important too. And also understanding your strengths. I think a lot of people go from single and multi and they realize, well, it's just hard to scale. The numbers have to be so high to scale and do well in this that then they start looking for larger investments. Is that what happened to you? Because I know you had started to buy apartment buildings and then eventually you decided, well, there's got to be a better way to do this.
Yeah, and it's mostly the kind of the shift from multifamily into other asset classes was a cap rate
Mm,
situation where there was so much interest, in that migration from single family duplexes over to smaller apartment buildings, even mid-sized apartment
yeah.
buildings, that it really drove the cap rates down. And that adjustment kind of pushed me over into looking at other things. And we have a management component to our operations. And we do that in house, and we kind of looked at what the complexity was for self storage, for example, and then even in the commercial space. And the reality was, yeah, there's some nuances in how things are handled, but generally, maintenance calls are maintenance calls. And as long as we have the systems and processes in place, we can leverage across multiple asset classes, and that's ultimately what we did.
So over your career, right now, what's your favorite asset class to participate in, whether it be as an operator or an investor? Because I know you've been involved in obviously the things that we talked about, single family, multifamily, but also self-storage, commercial retail, hotel to apartment conversions. If you could just choose and the cost was an issue, what's one that you're really enjoying right now?
Well, I actually think it's one of the adjacent categories in the real estate space, and
Mm,
I'll call it borderline on the lending side right now.
yeah,
There's a premium on lending and inserting yourself either from a hard money perspective for the industry that's still, going on relative to fix and flips,
yeah,
or I'll call it the pref equity or rescue capital that's going on in the space, generating kind of a premium location to insert yourself into in the asset that, yeah, if everything recovers well, the general equity position that was there before hopes to regain ground. But generally speaking, you are looking kind of at the bottom and inserting yourself at a price point that's really an opportune place to make either a pref guaranteed return or be in a really solid position for starting of the ramp up compared to just inserting yourself into a deal that has all of the risk. Last position, I'll call it.
yeah. Yeah, it's interesting because I think people forget about the lending arm as really it's based on real estate, so it's still really a participant in real estate. And I know a lot of people who, as their portfolios increases, they started lending more because it just made sense, and it's a little bit more hands off if you're judging the assets. So that's something you've been involved with as well, of course, over the
Yeah.
years. When did you start Navigator Wealth Management, and what do you guys do there? Because I think that it shows the growth of your portfolio, getting into something like that is then going to be more overseeing what other people do.
Yeah, I personally always had the mantra of helping others invest and make returns when they're too busy or don't have the knowledge base to be able to do that. So, we were syndicating some assets, and then we looked for a more efficient way to address the syndication side. And getting to the fund to funds status has given us that opportunity to kind of streamline the activity and bring all of our investment information and opportunities into one place. So about just over a year ago, we started Navigator Wealth Fund, and that is our kind of foundation to be able to bring opportunities, whether it's hard money lending, whether it's mezzanine debt,
Mm,
whether it's pref equity positions. That's our vehicle to kind of start there, launching those activities out, and also down the road when things kind of turn to the other position where general syndication comes back to make sense again,
yeah,
we'll go that path through that Navigator Wealth Fund also.
great. Can you just explain what a fund of fund is? Because that is gets tossed around, but I don't think people really
Sure.
understand what it is.
Sure. And we're in a particular segment of it, but we're structured under a 506C offering. So it's accredited investors only at this point. And more specifically, because we want to be operators and function with the assets, because we really believe that having our hands in it to
Yeah,
ensure that the financials are sound and that things are happening and we can make the corrective actions necessary, we need to be involved in it. So we've actually structured under what they call the 3C, 5C exemption, where we must be involved with the asset and have decision making. And in doing that, it gives us the opportunity to invest in things like hard money activities where we have an asset backed situation. We can work on a specific investment syndication, buying a particular storage property or apartment
right.
complex, as long as we're managing it, and we can continue across the spectrum of different asset classes. We don't necessarily focus on one, but we look at the skill set of being able to understand and analyze the deals and bring those opportunities to folks in a kind of a diverse asset class opportunity way, and be able to get them consistent returns by entering and exiting different things. When I talked earlier about how cap rates compress in one category versus another,
Yeah.
necessary to shift in order to stabilize and hold that higher level return for your investors. You may have to move around asset classes.
Why is mezzanine debt so popular right now? I keep hearing it, and I don't think anybody knows what it is, but I know it's
Sure.
very popular.
Sure. And there's more than one kind of category of it, but it's a fairly loose term, right?
Yeah,
In our particular case, what we've done with some of our mezzanine debt is actually become the second position. So the bank is in first position on a multifamily property, and we'll insert as a second position
yeah,
lender in that. So it's in front of, it's even better than that, in a more secure position than that pref equity that we talked
right.
about earlier. The mezzanine debt, if you can get it secured, it gives you an opportunity to be in on a property that, if things went sideways on it, you're still pretty well protected from a valuation
Yeah,
standpoint, and it may give you an opportunity or force you, and I'll call it potentially force you into an opportunity to either take over that asset from a foreclosure standpoint, but in any case, financially offers you an opportunity to have a first dibs on an asset that may be appropriate. And yet it still provides, because it's mezzanine debt in second position, it still provides a higher level of return compared to a first position note, and gives the investors, kind of a good balance between the risk and the reward.